Good afternoon, ladies and gentlemen all, and welcome to our conference on policies to puncture the student loan bubble. I'm Alex Pollock, a resident fellow at AEI, and my colleague Andrew Kelly at the other end down there and I organized this conference together as a joint venture of AEI's finance and education departments, and we are delighted that you are all here. Looking at the rapid growth in student loans from a financial perspective, which is my normal way, we see quite a typical interaction of a credit expansion and price, similar to what happens in housing or in any other asset bubble. Pushing credit at a sector makes its prices rise, and rising prices, like college costs, lead to cries that since costs are now unaffordable, we need more credit and easier credit besides. And this is a self-reinforcing dynamic of increasing credit and increasing prices. And this dynamic is all the stronger if there are important parties involved who get the cash from the loans but have no risk at all when the loans default. In the housing bubble, such parties included lenders who originated and sold their loans and therefore departed from the party. In education, the most important such risk-free beneficiaries of lending are the colleges themselves, who raise their prices, get the cash, and don't have to worry about what happens when the loans default. Now, interacting credit price run-ups typically come to face a problem, which is growing defaults. In a recent paper, the Federal Reserve Bank of New York observes that, quote, the measured delinquency rate, and here they're talking about 90 days or more past due loans, the measured delinquency rate on student debt is the highest of any consumer debt product. This measured rate, according to them, is 17%, a very high rate of delinquency. However, the New York Fed goes on to say that the real, or what they call the effective delinquency rate, and that is where in the denominator you don't count all the loans because a lot of the loans aren't being asked to pay. You only count the loans which are being asked to make payments. And if you count delinquencies 90 days or more over those actually having to pay, the delinquency rate becomes 30%, according to the New York Fed's calculation. Now, interestingly, 30% is the same as the peak serious delinquency rate of subprime mortgages during the worst part of the housing bust in 2009. In my view, among the things to be done in the student loan sector is to address the free rider problem in the student loan sector, namely the colleges, who are the free riders on the risk. They should cease to be free riders, and there are two ways we might think about. One which I have previously proposed and still think is a very good idea is that the colleges should have credit skin in the game in student loan risk. That is to say, they should share in any losses on the loans to their own students. Now, skin in the game was one of the biggest lessons that everybody learned, or at least said they learned, from the housing bubble. In my view, each college should be on the hook for, say, 20% of the losses of its own defaulting students, or the losses these defaulting students cause. A second idea suggested the other day by my friend Arthur Herman, which should appeal to everyone on the leftward side of this debate, is to have a wealth tax on colleges to help fund the cost of student loans. Now, of course, this should only apply to the wealthiest colleges, let's say the top 1% of college endowments, not 99%, needless to say. Now, there are about 2,800 four-year degree granting colleges in the United States, so the top 1% would be 28. You can easily guess who these institutions are. There is a serious inequality problem here. 1% of the colleges have 51% of the total endowments. This is obviously unfair, And as suggested by Thomas Piketty, a 5 or 10% wealth tax on this wealth of the top 1% seems about right. This tax could go to offset the losses on student loans. However, in my proposal, any college or university would be exempt from the tax, even if you're in the top 1%, if less than 3 of its faculty members have supported more taxes on the wealthy. But if 3 or more of your faculty members have supported higher taxes on the wealthy, then this tax would apply to that member of the unfairly advantaged top 1% of colleges. And I imagine with this criterion, all 28 of these colleges would indeed be paying on their endowment. Brian, let me stop right there for a minute to say we need more chairs for our colleagues who are standing back here. Where's my AEI team? Can we get some more chairs while we're talking, so people, we're really thrilled at a standing room only crowd, but we don't want you to really have to stand. Anyway, this idea of taxing the wealth of the top 1% of colleges to offset losses on student loans, I think we can make this comment: a higher degree of poetic justice would be hard to find. Now, we have a lot of other ideas on this topic, and we have an excellent panel today which will consider the issue of student loans and whether we're in a bubble, and in any case, what we should do about them and how high college costs relate to this problem. Let me introduce the panelists in the order in which they will speak. First will be Jason Delisle, who is the director of the Federal Education Budget Project at the New America Foundation, where he researches federal education policies, develops new policy proposals, and oversees a database on federal funding for every school district and institution of higher education in the country. This work has been cited in many national publications. Previously, Jason was a senior analyst on the Republican staff of the Senate Budget Committee, played a key role in developing education legislation, and was a legislative aide in the office of Congressman Thomas Petri, who's been very active for years in these issues. Our second speaker will be Andrew Kelly, who is an AEI resident scholar and the director of the Center on Higher Education Reform. His research focuses on higher education policy, innovation, financial aid reform, and the politics of education. Andrew is co-editor of Stretching the Higher Education Dollar, How Innovation Can Improve Access, Equity, and Affordability, of Getting to Graduation, the Completion Agenda in Higher Education, and of Reinventing Higher Education, the Promise Innovation, and, as mentioned earlier, Andrew is the co-organizer of this conference. Third will be Matt Chingos, who is a fellow at the Brookings Institution's Brown Center on Education Policy, who has written extensively on education issues, including co-authoring the book Crossing the Finish Line, Completing College at America's Public Universities. Matt's studies include both the K-12 and post-secondary levels. His current research examines online learning, quality of post-secondary instruction, student loan debt, public employee pensions, and the effects of school districts. He has just co-authored a new Brookings report, Is a Student Loan Crisis on the Horizon? Our last speaker will be Rich Vedder, a distinguished professor of economics at Ohio University, director of the Center for College Affordability and Productivity, an adjunct scholar at AEI, and previously a member of the Department of Education's Commission on the Future of Higher Education. Rich has written widely on higher education and American economic history, including The American Economy in Historical Perspective and Going Broke by Degree, Why College Costs Too Much, and the new Dollars, Cents, and Nonsense, The Harmful Effects of Federal Student Aid. And if you haven't gotten one of those, that monograph is available in the reception area for you to take. Now, I'm sorry to say that Rich's biggest problem is that he is too shy and timid about his iconoclastic ideas, but we hope that today he may overcome his normal reticence. Each panelist is going to talk from 10 to 12 minutes. After a chance to react to each other or clarify points, we will open the floor to your questions, and we will adjourn promptly at 2 o'clock. Jason, welcome, and you have the floor.
Okay, thank you. Pull up those slides. There we go. Okay. So in all these conversations about student loans, student debt, delinquency, 1.1, $1.2 trillion, an affordability crisis, et cetera, I want to get people to sort of be thinking about the role of graduate school loans and professional school loans in all of those discussions and in the student debt conversation in general. It's usually overlooked or just lumped together as if graduate school is part of the college access story. And I'm not sure that we would all draw that conclusion if we thought about it more carefully. And I'll tell you in a few minutes why I think it's really important to break out grad school and professional school from undergrad. But first, let me show you how these two types of debt get conflated and confounded in the discussion. So last fall, if you were reading the Wall Street Journal, you would have read an article about the trends in college pricing the College Boards put out, saying that, yes, indeed, college prices, college, by the way, four-year college, prices are still rising, and students are still going into debt in greater sums to finance these rising prices. And in the story, we learn about Nicole Prusel, who is a public university student with, wait for it, $60,000 in student loans. So Nicole is supposed to be an example of someone who is going into lots of debt to go to college. But later we learn in the article, and not necessarily directly, you have to be reading very carefully to put this together, Nicole actually only has $10,000 in student debt from her undergraduate degree. She had a scholarship, she worked part-time, and she left school with only $10,000. She's actually done pretty well. She's sort of a success story in that regard. But the $60,000 in debt, so $50,000 of that, is, and what makes it a really big shocking number, is the debt from grad school. By the way, she was pursuing a Master of Social Work. So talking about institutions being off the hook, I think it's a little bit unconscionable that a public university would sell you a Master of Social Work for $50,000, but so be it. So now, many people, when I point this out about the grad school debt here, and these stories are out, a lot of these stories are out here, where you see the really large student debt stories, it's almost always grad schools involved. Grad school is doing this sort of heavy lifting here in this story. But I wondered, geez, are these just outliers? You know, there's this whole story that these people with really large debts are outliers. But I wondered, are they outliers within the sort of grad school story, right? If we're just looking at grad school, has borrowing been going up a lot to finance grad school? So what we did is, I did a study this past winter where we used the Department of Education's NIPSAS survey. We used the 2004, 2008, and 2012 survey results, and we looked at graduate school borrowing. And we adjusted the numbers for inflation. So all the numbers I'm going to tell you and show you are adjusted for inflation. So give me the first slide here. So it turns out that Nicole is not an outlier. So I'm showing you the other master's degree category here from the NIPSAS data. So in 2004, I'm sorry, are these white numbers and people having problems seeing them? Sorry about that. So in 2004, the median amount of debt for somebody who borrowed and was in this sort of other master's degree category left with $32,000 in loans. And that's the combined debt for undergrad and grad. So that's what she's actually going to be paying. By 2012, the number, remember, already adjusted for inflation, had jumped to $55,000. So that's the median amount of debt for people who borrow and finish. At the 75th percentile, we went from $47,000 in 2004 to $88,000 for this catch-all other master's degrees. Now, a lot of people think this is we've been hearing this story, oh, the law school students, the med students, they have these huge amounts of debt. But this is a pretty generic category. This is a 2-year master's degree. You do the next slide. So here's a Master of Arts. These trends are very consistent across the master's degree. So for a Master of Arts, we've got the same kind of jump. And the Master of Arts, by the way, we're talking mostly humanities here, but there's not really tight definition around master's degrees, as I'm sure you will find. 38,000 to 59,000. The median, the 75th percentile, is absolutely shocking. It's 60,000 to 90,000 from 2004 to 2012. I mean, that's the 75th percentile. I actually was more expecting that'd be like the 95th percentile. The next slide, Masters of Education, same trend, except a little bit more troubling here, Master of Education, because we sort of know what these folks are going to be making. But we're seeing at the median debt level is 51,000, and that's 75th percentile. 80,000 now, that's up from 53,000. What I think Masters of Science is the same. What actually is interesting in this trend too, in the next slide, is the MBAs. MBAs are flat. There's no increase in debt after you adjust for inflation at the 50th or 75th percentile. That sort of makes the study, which I think it shows it doesn't have to be that way, that people are making different choices in these types of degrees. Actually, when we first put this out back in March, a reporter called me and said, what's going on with the MBAs? And I said, well, I have some theories, they work, et cetera, and I was sort of rambling on. And he goes, maybe they could just do math. I didn't say it. He did. So there is a real change in what people are borrowing to get a master's degree, and these numbers are not outliers within the master's degree category themselves. But before anybody misinterpret what I'm saying, I am not leading up to the solution of, oh my gosh, we need to help these people. We need to subsidize them more. And this is getting back to my point of why I think we need to think about college. When we're talking about college access, we're not talking about this. Graduate school is something very different than the four-year degree. First of all, graduate students, by definition, already have a four-year degree. So they already have a lot of different means of financing education available to them. They can work, they can save. They've already sort of made it past this first rung. And also, the sort of rationale for making credit available for undergraduates is that, lenders can't really tell who's good risk, who's bad risk. But here you've got a set of people who already have graduated from college. So we've got some great criteria to determine whether or not they should get a loan, perhaps from a private actor. But in fact, when I argue, and also remember, we do have a college access problem and a college cost problem. So this right now, we shouldn't necessarily be putting more money into graduate education for these people. We should be putting it into access for low-income families to go to college. So I actually think that the priorities would be way out of whack there. I think it would be hard to say we need bigger subsidies for people to go to graduate school right now. Except that is actually exactly what we are doing. Federal policy makes credit available for graduate students with no limit. You can borrow an unlimited amount of money to go to graduate school, basically no questions asked. So, and now we have sort of this proliferation of boutique graduate programs. I think what we have in this country is now open enrollment graduate school. I think you'd be hard-pressed to find a graduate school that wouldn't take somebody somewhere. And once they get in, the federal government lets them go, no money down. So I think this is a big problem. The other issue here, though, is that going back to our example of Nicole, in the beginning, $60,000 in debt. What is never mentioned in this article, Nicole's not going to pay back her $60,000 in loans. She's going to get public service loan forgiveness. In fact, once she reached about $30,000 in debt, she stopped incurring any marginal cost to borrowing an additional dollar, which means every single dollar she borrowed beyond that would be forgiven. And that's assuming she earns at about the 75th percentile for a social worker based on her age. So that in and of itself is a serious problem. You've got unlimited borrowing, no questions asked, and you've got very generous loan forgiveness to income-based repayment on the back end. So you imagine, if we want to go back to housing policy, if you could borrow an unlimited amount of money to buy a house and pay it back based on your income and have it forgiven after 20 years, how much house would you buy? I'd buy several. So since we're here to talk about solutions, let me give you a couple to this graduate student debt issue. I think we should really think hardly about ending the Grad Plus program. Unlimited borrowing for college is a problem. And it's only for grad school. Undergraduates have strict limits on how much they can borrow. And I think we need to rein in some of the benefits of income-based repayment. So for example, if you've borrowed more than, say, $40,000, you don't get loan forgiveness after 20 years. It would be after 25 years. So you'd pay for longer if you borrowed more, and this would be to get at the grad students. We also need to cap public service loan forgiveness. I think it is a serious error that public service loan forgiveness has no cap. It's unlimited. I usually start out that comment by saying we need to cap public service loan forgiveness at maybe around $30,000, which is all you can get in Pell Grants. Seems fair. And people say, well, what's the limit now? There is none. It's totally unlimited. They're like, they said, that can't be. That can't be. Here's the other one. This is a little bit more controversial, I think. My colleague Kevin Carey has surmised that the graduate programs in this country really are for-profit colleges, even if they're at public universities. I mean, we all sort of a wink and a nod. Everybody going to grad school knows, yeah, I'm not getting a subsidy. They're charging the full price for this. In fact, I'm probably subsidizing somebody else. So, since they are for-profit, and since we have a massive debt problem that's growing very rapidly, I think we should have gainful employment rules for all graduate programs in this country. Let's throw them in with the gainful employment regulations that the Obama administration has proposed for the for-profit colleges.
Thank you very much, Matt. This brief here, if people want to get it, what do they do?
That's all right. So this is the Graduate Student Debt Review. You can go to our Ed Central site at New America for the Education Policy Program. It's available there. So the Graduate Student Debt Review.
Thank you. Andrew.
I already failed the test of turning on the mic. Thank you, Alex, for co-producing this with me, and thank you to my friends on the panel who were gracious enough to join us. Jason and I make a nice bookend, I think, for the start of the panel, the conference, because he's talking about borrowers that I think we both would agree we pay too much attention to and that are extremely loud. Whenever anybody writes a piece about student debt, if you read an article about student debt and loan forgiveness in particular, it is a fact that you will receive hundreds of nasty comments from graduate school borrowers, which Jason and I have traded emails back and forth with our favorites, which is always fun. And what I want to talk about, though, is the other end of the spectrum, and I think Jason put it really nicely, which is we still have a college access problem, and what we're doing by subsidizing grad student borrowing and loan forgiveness is we're running the risk of sort of depleting our ability to serve the people that really need it and need the financial assistance. And the people in particular that I want to talk about today are the people who have debt with no degree. So the people who go to some amount of undergraduate education and who leave without a degree. And I want to talk about how that's a structural problem with the higher education system, and it's going to require a lot more than just rethinking repayment plans. It's going to require some changes to the incentives for colleges, like Alex discussed. So, most of the focus of stories on student debt focus on graduates typically, right? The whole conversation around whether college is worth it or not, quote unquote, tends to compare graduates to high school diploma holders, right? And we actually get it on both sides. So when we're talking about whether college is worth it and whether taking on the huge debts is worth it, we compare college graduates to high school diploma holders, right? And then if the delta is big enough, we say, see, it was worth it, right? But the other times, other stories tend to compare graduates with debt to graduates without debt, right? And then to talk about how painful it is for graduates. So graduates with debt can't buy houses. Graduates with debt have less wealth. Of course, that's not really the right counterfactual, right? What did that debt buy them? That debt bought them a college education. So it's probably right to compare the graduate with debt to the non-graduate without debt. That would be the accurate one. So this is fine and good. We should have this conversation about whether college is worth it and focus on graduates. But the problem is we leave out a huge swath of the population, right? And that is, what about students with debt and no credential? This is a growing group. So this is from the Beginning Post-Secondary Student Survey. It's a longitudinal survey that NCES runs every few years. And the cohort from the mid-90s, 37, this is looking only at borrowers in BPS, so people who had any loan balance at all. 37% hadn't completed after 6 years in school, completed a certificate or a degree. By the latest cohort, and again, these numbers are sort of dated now, even this only goes up through 2009, that number had grown to 46%. It likely understates the number of people who have student debt and no credential because it only looks at beginning post-secondary students, not students that started and then went back to school and accumulated debt. So it's a growing group. Their balances are growing as well. I didn't put a slide together on that. Their balances are growing. They're not huge because a lot of these people take a small amount of courses. They take a semester's worth or a year's worth of courses, and then they drop out. They decide that they don't want to continue, or they can't afford it, or any number. Oh, that's good. God bless it. Windows is terrific. So balances are growing. They're not huge, right? But it actually turns out that
Could you borrow Andrew to learn how to run that computer?
yeah. I could probably get a master's degree in Windows computing. Gosh, this is really.
Just keep rolling. You're okay.
Is that going to work now? Okay. So as I said, the balances among these folks are growing. They're not huge compared to people who finish, because people who finish are there longer. But this is from a terrific paper by one of Matt's co-authors, Beth Akers. Beth wrote a paper for us here at AEI as part of our series on reinventing financial aid, and she looked at the incidence of financial hardship among different kinds of borrowers and at different levels of debt. So on the x-axis here is the level of outstanding debt that you have, and on the y-axis is the probability of paying your bills late, right? So the top line is people with some college. Right? You can see that they are much more likely to pay their bills late than somebody without college, and you can see that there's sort of a bulge right there at that low level of outstanding debt, right? Which suggests that they're having trouble paying back even minimal amounts of money. They're having trouble paying their bills on time, even with minimal amounts of debt. Where else do we see this? We see this in the fact that these are numbers from the CFPB. Average loan balances among people who default are actually pretty low compared to people in other repayment statuses, right? You can look at compare it to people who are in the grace period or actively repaying or in deferment or forbearance, and the balances that are defaulted are the lowest average balances. Right? So people are having trouble paying back low amounts of student debt. And then this was from a great study by Pew that recently came out using some of the same data that Matt Chingos used in his paper released yesterday from the Survey of Consumer Finance. And it found that people, non-college graduates, right, had about the same same income, whether they had student debt or not. But non-college educated folks with student debt had much lower net worth. And if you look through the rest of the report, that group stands out as doing the worst on these measures of net worth and wealth. People who have gone to some college, have some debt, and have nothing to show for it. And this why does this happen? Well, the major design flaw in federal financial aid policy for my money, from where I sit, is that it subsidizes any program at any institution at any price, right? And Jason's right. That's especially true about graduate school. And people might say, oh, well, no, Stafford loan limits are pretty low for dependent undergraduates. But guess what? There's Parent Plus loans, which function the same way that Grad Plus does. You can borrow up to the cost of attendance with no aggregate lifetime limit. Parents fixate on the school they want their kid to go to, and they'll pay the price. So this is just a project that I have that's ongoing. Where does student loan money flow? This gets to the point. So this is what I did here was I grouped colleges, 2-year and 4-year colleges and less than 2-year colleges by their graduation rates in 2012, by the 6-year graduation rates in 2012, and then I just allocated the loan disbursements from 2012 and 2013 from the federal government to colleges in these different pockets, right? So you can see it sort of sort of a normal distribution, right? But it's worth paying attention to the left side of this graph, right? And it's easier to understand it this way, right? This is the percentage flowing to each category of the total disbursement in this data set, right? Somewhere around 37% of loan disbursements for undergraduates, not counting graduate school loans, not counting Grad Plus or unsubsidized Grad Stafford, 37% goes to colleges with graduation rates less than 40%. People on the left might say that this is entirely driven by the for-profits. It's actually not. I didn't include these slides because of limited time, but if you look at public institutions, this chart, it's 39% of the money. For-profits is about 54, so they are definitely sucking some loan dollars into poor-performing institutions. So what do we do, right? Jason talked a lot about this, so I won't spend much time on the conventional response, which is to go in and bail out borrowers after the fact, help them pay back their loans, right? That's great. We can save borrowers from defaulting. That's a terrific thing. People can preserve their credit. They'll still pay their loans back. Cons, though, it does nothing to fix this design flaw, right? And it may even exacerbate it. Like Jason said, imagine if suddenly people started to get loan forgiveness and said, I only paid X to get this degree, which actually cost, in terms of the tuition price, $100,000, $200,000, right? So what do we need? We need policies that encourage enrollment and better options, right? So one solution I've written a lot about, we need more consumer information. The market in higher ed is notoriously opaque. We don't know what we're paying until we've actually gotten accepted and gotten a financial aid letter. We also don't know what the likely outcomes are. This comes from a study that I did with a colleague, Mark Schneider, from the American Institutes for Research, where we gave parents of high school age students information about graduation rates. We randomly assigned some parents to get information about graduation rates at local colleges, and some parents didn't get it. We found massive treatment effects. We found really big treatment effects for people with low educational attainment. So people who had not gone to college and people who had high school diplomas, telling them a bit of information about the colleges in their area really changed their preferences. But we have to acknowledge the supply side constraints, right? So the problem is the best colleges tend to be smaller, and they don't have much incentive to get any bigger. More demand just lets them be more selective. And Alex already talked about skin in the game, so I'll leave that at that. I would point out, though, I didn't actually realize that Elizabeth Warren so actively read your work, because she did propose a sliding scale of skin in the game, which we can talk about. Potential perverse effects, of course, colleges may just get more selective if we put them on the hook for this. And then the last point that I would point out and talk very quickly about is how do we align the incentives between the investors, the people who are paying the money for college, and the students themselves. Right now, feds say take the money that you're entitled to and go wherever you want as long as it's accredited. This is a paper that I wrote with colleagues Miguel Palacios from Vanderbilt, Antonio Di Sorrento, who works for social finance, about income share agreements where investors would front the money for college in return for a percentage of somebody's income over a fixed period of time. And we can talk about the policy implications there. We need to do some things on that front to make this market take off, but I'm happy to talk about it. I feel like I'm moving up against my time, so I want to make sure I defer to the men with brand new papers in the offing. So thank you.
Thanks, Andrew. Matt?
They should be. Is this one here? Post. I'd like to postpone, but it won't let me. I guess I got 7 minutes. You got 7 minutes, then it's over. I'll fix it. I'll fix it.
Start over again.
All right, well, I'll try and go quickly to at least get through my slides in 7 minutes and see if I can think of anything to say it's not on my slide. So I'm going to talk a little bit about the results from this new report that my colleague Beth Akers and I released just yesterday. And the idea here is really partly in response to the kind of the narrative in the media you read about that Jason talked about, the stories of folks with lots of student loan debt. I think a big idea underpinning that narrative is that there's a problem with student loan debt that's new. It's not just that we're somehow discovering a problem that's always been around, but there's really something new that's happened. So the goal of this paper was to track the health of the national market for student loans over as long a period of time as possible, in our case back to the late 80s and early 90s, to see how has the picture of financial well-being of both the typical borrower and at borrowers at the more extreme end of the distribution evolved over that time period. How have the levels of debt moved along with different borrower characteristics and perhaps in tandem to some extent with incomes. So if you flip to the first slide, someone operating this thing? Can you maybe start?
Sure.
Or full screen, or I don't know.
How do I full screen it? I don't have a Windows machine. It would really help to have a degree in this. Yeah. Full screen mode, where's that? There we go. Sorry about that.
That's all right.
There you are.
All right, so everyone knows that the price of college has gone up a lot. This chart shows you the increase in sticker price. If you look at data on how much people actually pay once you take into account scholarships and grants, it's not that bad, but that's still been going up true. It's particularly true at public colleges and universities. One idea I'll return to at the end is when we talk about a problem of student debt, to the extent there is a problem, a lot of that problem is really a problem of college costs. People, for the most part, don't borrow more just for fun, although there may be some behavioral issues there. They borrow more to pay for something that is increasingly expensive. But if you look at the trends in published tuition and fees, don't look a whole lot different from the trends in average borrowing. So if you flip to the next slide, So what we're looking at here is, if you open the newspaper and read about student debt, you often see figures for typical borrowing of someone at the end of college, typical borrowing for someone at the end of graduate school, combined grad, undergrad debt. We took a kind of a broader view and said, let's look at the population of households led by adults between the ages of 20 and 40. They're going to be at various stages in the repayment phase. Some in their 20s will be in college, they'll be just out of college. Some of them will have worked for some time, paid off some of their loans. Some of them will be in graduate school or after graduate school. Because we really wanted a broader look. And we looked at their outstanding balances on a per person basis across a nationally representative set of American households in this data set that Andrew mentioned, called the Survey of Consumer Finances, that gets administered every year by the Federal Reserve Board. So what this shows you is that the average balances for people with debt have been going up. So the idea that debt is higher now than it was a generation ago it's supported by these data, and it's supported by lots of other data. There's not a lot new here. If you look at mean debt, it goes up from about $6,000 to about $16,000 or $18,000 from '89 to 2010, and that reflects people to some degree in the right tail of the distribution, dragging up that mean. Because you look at the median, person kind of in the middle of the pack, that's gone up more slowly, from about 4,000 to about 8,000. So if you flip to the next slide, what you'll see is that while the averages are going up, the incidence of very high levels of debt, the kinds of stories you like to read about in the newspaper when they profile 10 people with $100,000 in debt, those people aren't a whole lot more common now than they were 20 years ago. Back in 1989 and 92, among people, most people didn't have any debt, but among households with debt, 84% were less than $10,000. And at the other extreme, there was really no one above 100,000, and maybe if you had 2% that are above 50,000. Now fast forward to 2010, the most recent year in our data, and you can see the average has gone up, and there are some more people up there. 2% above 100,000, 7% above 50,000, but that's still not the norm. And once again, I think folks already knew this, but this sort of confirms that these data line up with the other data sources we've looked at. So now let's move on to some more new findings. So one here, well, this was new until Jason published his paper before we published ours. And what it shows is that levels of debt have increased, particularly among graduate students. In '89, this once again is average debt among people who do have debt, going from about 10,000 to about 40,000 among households where at least one person has a graduate degree. And you also see increases among households with bachelor's degrees and among some college. And as Andrew mentioned, that some college group is a group we should worry about. The share of households with some college with debt has gone from 10% to 40%. Average debt levels looks like they've about doubled. And Andrew showed that nice chart from Beth's paper showing that's a group that is particularly likely to experience hardship at all levels of the debt distribution. So it's a group we ought to worry about. And in addition to just kind of looking at these differences here, which, were the graduate ones, the trend very much lines up with Jason's work, we also did a decomposition exercise where we asked what share of the overall increase in average debt can be explained by the fact that more people are going to college, more people are getting bachelor's degrees, and more people are getting graduate degrees. And that alone explains about 1/4 of the overall increase. So 1/4 of the overall increase is explained by the fact that regardless of the increases in costs and borrowing and whatnot, it's just people are going to college more, they're going longer, they're getting more degrees. Next slide. So next we turn to take a look at what's the financial health of households with debt. So you want to look at not just how much debt they're taking on more debt, but are they also making more money? And what we found really surprised us. So one comment you have to start with is a lot of times when people look at these data, they compare how much debt people have when they graduate from college or from graduate school, or how much outstanding at a given point in time, which is what we looked at here. They compare that measure of the stock of all their debt to how much income they're going to make in 1 year. So it's kind of like saying, someone saying, well, I make $100,000 a year and I own a $1 million house. And that tends to not be how people think about it, right? They tend to think, can I afford a $1 million house? Well, it has to do with, can I afford the payments I have to make every month? So we cut these data in 2 ways, and I'll try and drag out the explanation of them so that we can configure Windows updates and, and get back to the charts. But first, we want to take both a long-term and a short-term look at the financial well-being of borrowers and how measures of those things have evolved over time. So in the long run, we want to know if you're taking on more debt, the stock of your debt is going up. How does that compare to the stock of your earnings? Now, the stock of your earnings isn't how much you make in 1 year, it's how much you make over the course of your lifetime. So if you, in a group that on average is borrowing more now than it was 20 years ago, over the course of your lifetime, can you expect to make more money to make up for that? Because it doesn't matter if your earnings doesn't go up enough in 1 year to pay for the increase in debt. If you can pay it off with the increase over a couple of years, well, then you could still be better off over the course of your lifetime. So what we find is that in the long run, on average, and this is what that chart would show you if you could see it now, is that among households with student loan debt, average earnings and average debt have both gone up between 1992 and 2010. Average debt has gone up by about $18,000, and average earnings have gone up by something like $6,000 or $7,000. So now the increase in debt's bigger than the increase of earnings, but once again, that's all your debt and your income in just 1 year. Everything's in real terms. Everything's in 2010 dollars in the paper. So what that means is that the increase in your total debt is only 2.4 times the increase in your annual earnings on average. So basically, after just a couple of years of working, a typical, an average household with student loan debt in 2010 would be better off than an average household with student loan debt 20 years prior. So this sort of flies in face of conventional wisdom that people with loan debt are worse off than they were a long time ago. On average, it looks like they're better off. They're better off because their incomes have gone up. They haven't gone up a lot. Maybe they haven't gone up as much as we'd like them to have gone up over this significant period of time. But because those increases, we would imagine, add up over the course of your lifetime, it would offset that increase in debt. So now that's the long run. It could well be the case that in the long run you're all right, but you have this increase in debt, there's constraints on how you have to pay it off, and in the short run you're really squeezed. So there what we did is, instead of comparing the stock of your debt to the stock of your income, all your lifetime income, we said let's look in the short run. Let's look at the flows on both of those things. Let's look at the payment you have to make each month on your debt and the amount of money you make each month with which you could presumably pay for that debt. So just like when you're thinking about buying a house or renting a house, you think about, can I afford the mortgage payment or the rent payment given what I make each month? So when you look at the ratio of people's monthly payments to the ratio of their monthly income in the survey of consumer finances over this 20-year period, what we found was really remarkable. It surprised us. We didn't think it was right until we had run it 10 times in 20 different ways. But the typical monthly payment has been flat. The median household with student loan debt paid 4% of its monthly income on student loans in 1992, and it paid 4% in 2010. If you look at the mean, which includes, gets dragged up because there's, a number of people who have high levels of payment-to-income ratio, at least they were more likely to in the past, back in the 90s, the means actually declined. So the burden imposed in the short run on households has either stayed the same or it's declined over the last 20 years. And in the long run, on average, people are better off. Now, that's on average. Of course, there's always folks who are not going to do well, who are going to have problems. I have no doubt those people exist. Maybe there's things we ought to think about doing to help them. We've talked about income-based repayment. I think those policies are important. I think they could be improved, could be reformed, could be made more efficient and effective in a lot of the ways that Jason talked about. But the question we asked with these data was simple. Are there more of these big problem cases than there were a long time ago? We know there are more people who have large debt balances, but those aren't necessarily the people that have the big problems. Andrew showed that nice chart from Beth's paper showing that there's basically no relationship between how much debt you have and how many financial problems you have, whether you're likely to declare bankruptcy or be behind on your payments. That's because people who have large loan balances, a lot of them have high incomes and can pay for it. I think. Do I get a bonus for my snafu here? I guess not. I already got a bonus for that. All right. I was stalling to do that, but so I will wrap up quickly and say. So what really surprised us is that. So we were looking at these people who who have high balances. So there are some more of them. They're not necessarily a problem, given best work, which Andrew talked about. We also looked at, does the share of people who have high payment to income ratios, who are paying more than 10% of their income every month, or more than 15%, and more than 20%, are there more of them now than there were a generation ago? And there aren't, there are less. There are more people who are really squeezed on their payments. There were more people in the 1990s than there are today. So these data don't mean there aren't any problems, but I think it ought to cause us to rethink some of the kind of mass hysteria that sometimes occurs in discussions about student loan debt, and focus on figuring out where the real problems are and where the real solutions are. So thank you.
Thank you, Matt, and thank you for keeping rolling in spite of the fact that the computer dropped out on us. Rich.
In the time spent fiddling with the computer, Lincoln delivered the Gettysburg Address. Twice. I want to contribute $20 to the American Enterprise Institute to get a computer that works in front of large groups like this. It's a little embarrassing. And since my presentation is very much slide-based and I have absolutely nothing to work with, we'll wing it and see what happens. But as Liz Taylor told her seventh husband, I'll be brief. I want to outline 8 problems with our federal student loan financial aid programs in general, and more details are presented in this study, which actually, if you have, might come in handy because some of the graphs and all that I'm going to mention are actually included within it. So let me just run through these, and I'm going to it's going to shorten my presentation because virtually all the empirical evidence has just disappeared. First, the programs have significantly, here's 8 problems. 1, the programs have contributed significantly to rising college prices and costs. Then Education Secretary William Bennett declared in 1987, and I quote Bill Bennett, if anything, increases in financial aid in recent years have enabled colleges and universities to raise their tuitions, confident that federal loan subsidies would help cushion the increase. So in my presentation, I actually go through literally demand and supply curves. I was very proud of this graph. Too bad you can't see it. And what it shows is that because of the ability of colleges to raise their tuitions more because of aid, they do so. And this pushes what we in economics call the equilibrium price of education up. But now, does the evidence actually support this? The answer is yes. If you look at tuition fees and enrollments over time, you see the following. Before about 1978, annual real inflation-adjusted tuition fees went up about 1% a year. 1% a year. Now, the data is a little crummy on this, I might add, so it's partially an estimate. Part of it's based on the tuition fees at Purdue University, truth be known. For the most recent period, since 1978, the modern era, tuition fees, inflation-adjusted, have been going up, this is West Virginia PowerPoint, by the way, 3 to 4% a year. Oh, okay. Okay, yeah, I want you to see that I can draw demand and supply curves. Now, go on. So in table 1 here, you see us. So now I ask the question, what if the rate of tuition increases had continued after 1978 at the 1% a year rate rather than the 3 to 4 that has actually exists? What would tuition fees be like today? And the answer is about 59% lower. State universities charging $10,000 in in-state fees, which is a common fee today, would instead be charging a bit over $4,000. The elite private universities would have tuition levels around $18,000 instead of $45,000. In such a world, there would be dramatically smaller need for student loans. Moreover, this evidence ignores the fact that room and board fees in higher ed have soared as well, as figure 2 demonstrates. So room and board charges are even going up, which is interesting. You can think about that one for a while. Second, the programs have miserably failed at achieving their top goal, increasing the proportion of college graduates from low-income backgrounds. Federal data on college participation by income quartiles confirms that the percentage of recent graduates from the bottom quartile has declined since the early days of the student loan and grant programs. See Figure 3. In 1970, over 12% of recent college graduates came from the bottom quartile, the distribution compared with less than 10% today. Federal student financial assistance programs have pushed up tuition fees. Low-income students are price sensitive, so high fees often deter them from even applying. Third, these programs have contributed to a severe and growing problem of underemployment and unemployment among college graduates. Almost half of college graduates hold jobs that the Bureau of Labor Statistics estimate require less than a bachelor's degree. For example, we have over 1 million college graduates involved in retail sales, few of whom are in positions requiring such an education. While the overall unemployment rate in 2013 was 7.4%, it was 8.2% for young college graduates under 25. Federal programs have increased enrollments and the number of graduates. That in turn has exacerbated the underemployment problem. Now, the ability to pay off loans varies inversely with the ratio of debt to income. Several have said that here. If the Bennett hypothesis is valid, expanding federal assistance programs have increased debt because of higher tuition charges, but they have also led to a reduction in incomes because of the underemployment problem. Fourth, the federal student loan programs have imposed enormous financial burdens on taxpayers and borrowers. We've been talking about this all day, and I think I'll just let it go at that. Fifth, massive expansion in these programs has lowered the quality of American higher education. Now, this is a biggie. A seminal study of collegiate critical reasoning and writing skills shows that seniors typically are marginally better than freshmen. A periodic survey of adult literacy indicates a significant decline in basic literacy among college graduates. So despite evidence that modern-day students learn no more than earlier generations, today's students receive far higher grades than their predecessor. Moreover, students work far less than decades ago. Believe me, I know, I'm a college professor. As two authors put it, quote, full-time students allocated 40 hours per week towards class and studying in 1961, when Alex and I were still around in that field, whereas by 2003, they're investing 27 hours a week. So federal student financial aid programs increasing college enrollments and the proportion of Americans with degrees. But higher education is higher because the contents of it historically have required a high level of cognitive ability and discipline. As Charles Murray of AEI has put it, quote, for many years, the intellectual benchmark for dealing with college level material was an IQ of around 115, which demarcates the top 16% of the distribution. That, in fact, was the mean IQ of college students during the 1950s. It cannot be nearly that high today, end of quote. The federal programs have no academic standards, performance standards associated with them. Indeed, a student who takes 6 years to graduate because of poor academic performance often gets roughly twice as much federal aid as the one who works hard and graduates in 3 years. 6, the federal student assistance programs have reduced household formation and birth rates. There has been a decline in Americans in their late 20s buying homes with mortgages. The financial pressures posed by student loans have aggravated the decline. See Table 2. You look at that, just look at the table. The decline in taking out mortgages to purchase homes was over 38% greater for individuals with student loans than for those without them. The growing financial burden of student debt has led young Americans to defer marriage and having kids. While fertility rates have fallen to new lows, the decline is concentrated among younger people. Indeed, birth rates are rising among older women. See figure 4. 7, high delinquency rates in the loan program reflect the non-market-based nature of the loans, several have said this, and the failure of colleges to have skin in the game. Student loan interest policies are determined politically, although partially based on market-based conditions. The loan programs do not take lending risks into account. Much default risk can be predicted in advance based on applicant characteristics, academic major, etc. Federal repayment policies favor students taking low-paying jobs, since loan payments or repayments are increasingly limited to a proportion of income and a maximum number of years. Loan forgiveness provisions incentivize students to overborrow and delay repaying. Student loans originate in college and university admissions decisions, yet colleges whose students do not repay their loans face virtually no adverse consequences. Colleges have no skin in the game. Federal loan and grant policies encourage ill-prepared students to attend college, leading to poor performance, dropouts, and loan defaults. These students often assume large debts and obtain jobs little better than if they had skipped college. Forcing colleges whose students participate in federal loan and grant programs to have skin in the game, I think, would dramatically reduce this problem. 8th, the federal aid programs may have contributed to a decline in the rate of savings in the United States. Families have historically saved for a college education. Rising college attendance should stimulate higher personal savings. Yet personal savings rates are lower today than when a smaller proportion of students attended college and federal financial assistance programs were small. See figure 5. The personal savings rate falls sharply over time as federal student aid increases. While without federal financial aid programs, students have to save for college expenses. With those programs, families shift from saving before the fact to students saving after it. And I think much more study of this issue is needed. Okay. The federal student financial aid system, in short, is failing. It contributes to skyrocketing costs, finances a wasteful academic arms race, weakens academic standards, lowers educational opportunity, and worsens the underemployment overinvestment problem. In a perfect world, the federal programs would be abolished. A more realistic solution would be to drastically downsize them, make them smaller and more progressive, only helping lower income students. For example, abolish the tuition tax credit, the PLUS loan programs, and generally tighten eligibility requirements. Return the programs to being a useful financial support to qualified, needy students, thereby by moderating tuition price inflation and stop or slowing the decline in academic standards. Allow private income share agreements wherein, perhaps, where students sell equity in themselves instead of debt. Andrew's point. Force colleges to have skin in the game. Reject short-term panaceas, lowering interest rates or loan repayments, including loan forgiveness. Moving to a fiscally responsible system with a vastly reduced federal presence will help the nation restore fiscal responsibility while improving its higher education system. So thank you.
Thank you, Rich. What do you really think? I want to give each member of the panel a chance to react to what anybody else has said, or add something, or clarify something. About a minute, 2 minutes, absolutely max. And we'll just go in the same order. Jason, something you want to add?
Well, so I wanted to ask Matt, who made this great observation using this data that, you know, the debt to income ratios, the debt to payment ratios, or payment to income ratios haven't really increased, even across all the percentiles. But we still then sort of are left trying to explain this 30% delinquency rate, which is way up, and the default rates are way up on the loans. The lifetime expected default rate on a subsidized Stafford loan in 2007 was about 11%. It's now 24% on newly issued loans. So what do we, I mean, we still, would you agree we still need an explanation as to what's causing all of that, but it seems like you're saying it's not necessarily that the payments are unaffordable.
No, go ahead and respond, and then you can have another minute of your own.
I think it's a great question. I think we absolutely need to better understand why defaults and delinquency are going up, especially in light of this new evidence that the financial picture or well-being of households hasn't changed that much. I think it's important to note that delinquency and default reflect not just the financial well-being of a borrower, but also behavioral aspects as well. So what we tried to do with the SCF data was look at a broad picture, a broad group of borrowers, and a measure of their financial well-being, levels of education debt, incomes. Whereas delinquency and default are more extreme measures that capture both hardship but also behavior. So in the federal loan program, the delinquency and default rate should be 0 because we have programs called income-based repayment where if you can't afford your monthly payment, you can sign up for this program and they absolutely can be made better. These aren't particularly well-designed programs. But they do exist, and if people knew about them, they shouldn't be defaulting or becoming delinquent on their loans. So I think we absolutely need to better understand what the behavioral components are there and what's behind those increases.
Thanks. You want to add anything else? Some other comments?
Sure. Yeah, so I didn't talk too much about policy-type solutions. I agree with a lot of the points that have been made, particularly the skin in the game phrase, which I think everyone uttered, so I'll utter it too because I'm sympathetic to it. I think it also, particularly a lot of the points that Rich made highlight kind of the real challenges out there facing higher education, and most of them, they're peripherally related to the debt issue, but they're not really directly about the debt issue. So, on the loan programs, on kind of the repayment end, I think we ought to fix IBR, do stuff like that. But the real questions are about costs, are about quality, and are about the front ends of the loan program. How much do we let people borrow? This sort of crazy policy that Jason talked about, where you can borrow to go to any graduate school up to whatever they feel like charging for it. The one point that Rich made that I would push back a little bit on is some of this evidence that often gets cited about the effect that student loan debt is having on the economy, on things like homeownership and family formation and whatnot, because I think that almost all that evidence really withers upon closer examination, but kind of gets cited too often. You pick up any newspaper and you can see the statistic that Rich showed us, which is that based on a New York Fed data between 2003 and 2012 or 2013, the share of home ownership rates declined among young folks. And for the first time in 2013 or something like that, the rate of home ownership was lower for people with student loans than those without. That gets bandied about all the time as evidence that this is the sort of causal effect of student loans. But my colleague Beth Akers looked at the SCF data that we used for our project, which go back earlier than the New York Fed data, and found that supposedly new finding the New York Fed told us about in 2013 is actually a return to how things were back in the 1990s. It doesn't mean that student loan debt isn't having an impact on home ownership, but it means that using that one data point to make that claim is bogus. And we would need a much better evidence.
We're going to let Rich respond to that when it's his turn, but Andrew, any additional comments?
I just want to say one thing that came to mind when I was watching Rich's presentation, which was it's no surprise that you use 1978 as your marker, the Middle Income Students Assistance Act, right, which sort of led to this morphing of the federal role in financial aid from a set of policies that targets the neediest students to a set of policies that targets a much broader swath of the population, and that policy broadened it on the front end, and now we have lots of repayment proposals and refinancing proposals that are essentially broadening it on the back end, right? They're designed to deliver benefits and subsidies to people who've already gone to college, which is, to my mind, not the logic. It doesn't solve the underprovision problem, which is why we supposedly got in this in the first place. So.
Thank you. Before we come to Rich, Matt, I meant to ask you before, if people want to get a hold of your new paper, what do they do?
So they can go to the Brookings website, I guess if you Google the Brown Center on Education Policy, it should be our most recent report since it just went up yesterday.
Thank you. Rich, other comments?
Well, this is one of those rare sessions I've been at where it's kind of a love fest. I nearly agree with everything everyone has said. Even Matt's little gentle criticism of me, I agree with, because I was figuring 8 was a better number of points than 6, and I said, well, I'll put in something on savings rates and whatnot. And that was more conjectural than real. And indeed, I said so in my longer remarks. I said, we need to study this more. I don't think this is really the main factor in any mortgage problems or anything. At best, it's a minor part of the picture. I do think something someone said earlier reminds me of the word that none of us have used, moral hazard and so forth. One reason I think a lot of the people are lingering and repaying is it's a strategic decision. I think a lot of them are thinking the government is going to come along and take care of me. And they have on several occasions in the past. They've lowered interest rates on loans. They've come along, or their proposals, Senator Warren's proposal, President Obama's proposal. All of these things are designed to help. And what is, for example, I don't want to get too long on this, but Senator Warren's proposal, if I had debt that I've taken out in 2010, I've been religiously paying that down at X interest rate, 5 or 6%, and now Senator Warren says, oh, from now on it'll only be whatever, 3.8. I think that creates some inequities. I think it creates some injustice of a different kind. It's anti-responsibility. It's against fiscal responsibility. And I worry a lot about our nation becoming a nation of people. We don't have to repay our deals. The government will take care of it down the road. And I think that may explain some of this story about delinquency that was raised particularly by Jason in his comments.
Jason, you have a comment on moral hazard, I think.
Well, but I actually think it doesn't explain the delinquency issue, because as Matt just said, it should be impossible. But people don't know this is available, so you can't know the benefits are not available, but then also be thinking the government will just take care of you, right, in your decision making. I mean, those two things don't really go together. So we're still left with this explanation of, but I do think there is moral hazard on the grad student side, and I think it's starting to ramp up as people become more aware of income-based repayment, and particularly the public service loan forgiveness benefit, where you get loan forgiveness after 10 years, paying 10% of your income, which is just, by the way, 10% of your income, which is your adjusted gross income after an exemption, so we're not really even talking like 5% of your income here. 10 years is not long enough to repay graduate debt. It's not like those numbers, they don't work together. Like that, you've put your thumb on the scale so far that you can't not get loan forgiveness in the graduate side. But I do think this issue of trying to figure out, I don't think the people who are becoming delinquent and defaulting we're expecting a sort of bailout. I think there's a much more complicated explanation lurking in there somewhere.
All right, a great discussion, great presentations by the panel, and now we come to your chance to ask us questions. There will be microphones. I'm going to start with you, and then we'll move over to these questions here. Let me remind you, we ask you to tell us your name and your affiliation and to state a question. If you feel a compulsion to make a statement before your question, you have 30 seconds to make such a statement. And if it goes longer than that, you will get a reminder from me that it's time for your question. We'll start here, please.
Thank you. No statement, Mr. Chairman. I'm Elizabeth Morgan from the National College Access Network. So we're seeing all the HEA proposals coming out now on the Hill. And I'm wondering if you could each say, maybe not each, but a couple of you say something about whether some of the reforms you're recommending are showing up in any of those bills, particularly because it seems like some of them would be really great pay-fors.
Anybody want to take that? What do we see about our ideas showing up in the bills? We used to write these bills, Jason.
Right. Some of them are sort of light on details. Some of them aren't even bills yet. They're two-pagers with sort of talking points. And I'm having trouble sort of keeping them all straight because they're all coming out at the same time. But it seems that people are acknowledging that the programs have become too complicated. There are too many options. there are too many opt-in things that people don't know about. And so it seems like there's a desire to make things simpler and a little bit more automatic. Now, of course, this is from the Congress that, made the programs complicated themselves. I mean, they're the ones, they did this, and so now they're saying, oh my God, can you believe how complicated these programs are? We've got to fix this. I think that, and then there seems to be some bipartisan support around those things, and doesn't necessarily cost anything. What remains to be seen now is what the advocates do in response to this and say, well, you're going to get rid of some of these options. We got 9 different ways to repay your student loans, and there's a group out there somewhere who has, wants those maintained. The high-income grad students like to be able to stretch out their loans over 20 years and make very low payments.
Other comments on the current legislative proposals? Andrew?
I mean, I think Jason's right. I think we saw movement on FAFSA simplification, which unrelated to some of the issues we discussed today. But I think that's actually that has a chance to move. It is a bipartisan bill, and on the student loan front, I think there's going to be a real discussion about skin in the game. I hope. I don't know that it'll make it in to the bill that goes to the floor if the higher ed advocates have anything to say about it. But at least it'll be on the agenda to discuss. That would be my prediction.
All right, next question over the gentleman here. Please wait for the microphone, please.
I'm Barry Wood, an economics columnist. It strikes me that the debate is completely disjointed, because for most of the debate in the public, it is that the banks are somehow the bad guys, and everything is focused on the loan rate that is being paid. And as a parent, I was just asked whether my son will accept a loan payment, even though he's now graduating. And it's almost as if in the FAFSA, an extremely complicated form, which I don't think most students do. It's the parents that do it. So how did we get to this point where things that this panel has said don't really comport to what the public debate is?
What do you want to? While the panelists are thinking, I will say, of course, as a general rule, maybe we'll be wrong this time, but as a general rule, every congressional effort to simplify things makes them more complex. But somebody want to take that question, Andrew? I
mean, well, on the FAFSA question, right? It's a natural trade-off between not wanting to give out money incorrectly to people that have more income and more assets than you could get at in a simple 2-question form, right? Which is the proposal that Lamar Alexander and Michael Bennett put forward, and that's been around. That tension's been around since the birth of the form, and so there's lots of interesting ideas about. People have even said, let's give people a guaranteed Pell Grant who get free and reduced lunch in 8th grade. Right, because they've looked at the data and they've shown that it actually doesn't vary that much. Your chances of being Pell eligible by the time you're in college are very similar. But Congress is not good at simplifying, as you pointed out. So,
I happen to have a wife who's a high school guidance counselor working in a low-income area, and she said the single biggest obstacle to getting low-income kids into college was the FAFSA form. And anyone who's looked at it knows if you go from 120 questions to 2 or whatever it is, you will lose some information. Andrew's quite right. There are some trade-offs. There may be some inequities. But the costs, those costs are trivial compared with the gains to society and achieving the goals for those who want greater access and so forth of doing it. I sat in at a Department of Education meeting that lasted 4.5 hours, where we went over every question from 1 to 120, and they insisted you've got to write your name in twice because you might write it in once. I mean, the bureaucrats fought tooth and nail against any change in the form. And Beth and Sue Donarski and I, who were sitting next to each other, professor at the University of Michigan, were going crazy. We were about ready to commit Harry over this. And this is a significant problem. So I'm all for Alexander and company's bill.
I want to raise a question about the FAFSA simplification. So I completely buy into the need for simplification, that it's a big barrier to people, that there's not much of a trade-off, that you lose very little. But my question's about the politics of what you do lose. So let's say we do the simplification. You're going to have kids of hedge fund managers who had a bad year getting Pell Grants. And is that going to create a real political problem for the program? I'm not saying it will. I just think it's a question worth raising. I mean, are those people going to be the welfare queens of the world of FAFSA simplification?
I mean, what I would say in response is that it's probably easier to add a third question, right, to a 2-question form that would help us to weed out those people in a future iteration, right? It's probably a better idea, I should say, right, to add a third question than to continue with 120 or 108 now, I think. I think they got it down to 108, by the way. Yeah, thanks to your hard work.
Thanks, panel. Thank you very much for that very stimulating question. I will say several years ago, I got a fair amount of publicity trying to get mortgage borrowers to be given a one-page form which simplified the information. They would get down to the essentials, which everybody agreed was a good idea, but we never could get done. At one point, we thought we were going to have a bipartisan bill in the House to have such a form. On the form I recommended at the bottom, it said to the borrower, do not sign this form if you don't understand it, because the whole point was to get you to understand what you were doing. But the Democratic proposed sponsor backed out because he said that, well, if you make people sign it, it means they're taking responsibility for what they're doing, which I thought was fairly amazing. A fairly amazing discussion. We do want people to take responsibility in student loans as well, it seems to me, for understanding what they're getting themselves into and not thinking this is just somehow a reduction of my college cost. This is money I'm going to have to pay, and really understanding what that means. All right, I had another question over here, I think. Okay, go ahead, and then we'll come over to you.
Thank you.
Okay.
My name's Lauren Broccoli. I'm from Lewisburg Associates. And my question's directed at Jason, but of course the rest of the panel as well. In regards to your discussion about how there's kind of unlimited credit for graduate students, is there a correlation, do you think, between expanding access at the undergraduate level for people, devaluing that 4-year degree, and then the influx of people going on to graduate school? Because practically speaking, as a disgruntled graduate student with a lot of debt, my peers, that's exactly what happened. I mean, it was trying to make yourself as competitive as possible for a limited amount of jobs and then seeking graduate degrees to do so.
Yeah, I mean, I think that's out there. I mean, there's this sort of getting this generic 4-year degree, and now I need to go specialize and get this 2-year master's degree. And I think you see this in the sort of, if you ride the metro in DC, you see the sort of boutique master's degrees, right? That all these places are rolling out. For some reason, they really like the metro. I think it's because like you're on your way to work and you're thinking about how much you hate your job right now, and you're like, I'm gonna go get that degree. So they've like figured out that's the spot to put that. But there's things that you've never heard of them. I mean, they're the most boutique specialized master's degrees you can imagine. They're essentially like certificate programs. And I think they're responding to exactly that. But also, the federal government, when you go to grad school, lets you borrow to pay for all of your living costs, as determined by the school. So if you don't have a job right out of undergrad, now you have a place to get money to live off of and go to grad school. And you could do it, 2 years, 3 years, and then they will never cut you off. So I think that fuels that as well.
If I could jump in there, I think that is a great point, and it relates to, if you think about a college or a university and you ask yourself how many businesses are they in, of course it occurs to you they're in the education business, but they're also in the hotel business and the restaurant business and the professional and all but named sports business and the entertainment business and the providing life experiences business, and all these businesses, all of which go into the cost and into the debt financing. Yes, sir, right here. Wait for the microphone, please.
Thank you. My name is Wang Tao. I'm from Caixin Media in China. So today's topic is student bubble. Sounds like not every speaker has gave a definition of the bubble. So in what sense do you think student loan is a bubble? Is that similar as housing bubble or something? Yeah, thank you.
Okay, thank you. Who wants to talk about student loans as a bubble?
There are some aspects of the student loan situation that resemble what people classically talk about as a bubble, but there are other aspects that don't fit. The aspects that fit include the fact that in a bubble situation, often people are able to get credit at a very low rate of interest, artificially low, and that they're able, therefore, to borrow exuberantly and borrow too much, to buy an asset that is really, they have misjudged the value of the asset, and this has led, in some cases, to then financial problems. In that broad, very nebulous sort of way, we have a student loan bubble. But it is a different situation when the federal government is involved. It's a different situation when we have, in this case, a forbearance, where we have loan forgiveness provisions and we have variety of other provisions that lighten the burden. It's also important that we do not have the same involvement of the commercial banking sector that we do in traditional bubbles. That involvement of the traditional banking sector leads to larger, broader implications, as was the case in the financial crisis of 2007, 8, and 9. That is not present to the same extent here, so it makes it a rather different thing. The others can add or subtract from what I said.
Thanks, Rich. Other comments?
I don't think the comparison is all that helpful. I would agree with a lot of what Rich said, but there are some important differences. One defining feature of a bubble, as people traditionally think about it, is that it can pop. As we saw in the case of the housing crisis. And I think in education, things that are kind of sort of like that can maybe happen to some degree, but it's different enough that I don't think it's a helpful metaphor.
I think it's a very good question. I said in my opening comments there's this interaction between the price of something and the credit of something, which is characteristic of bubbles and is characteristic of higher education and credit. There's something else. Years ago, at a previous financial crisis, by the way, financial crises come on average once every 10 years, ladies and gentlemen, because in 10 years we forget what we thought we learned. At a couple of financial crises ago, I was at a conference, and a banker said, there's no problem as long as the banks keep lending. And that's true, what triggers the end of the crisis is if the lending stops. And in a privately financed bubble, the day the banks stop lending is the day the bubble collapses. You could imagine if the government stopped lending, what would happen to the higher education sector, and then you would get something like a bubble collapse. But if you don't think the government will do that, then that analogy doesn't apply, as my colleagues have said. I have a question here, yes.
Carl Russo, the Joint Committee on Taxation. I have a question. All of you have mentioned about institutions having skin in the game, and why have you identified the educational institution as the one that should have skin in the game? It seems to me if you were to extend the housing analogy, that would say if I sold my house to a buyer who got a loan they shouldn't have gotten from the bank, that I should somehow give them money when they default on their mortgage. Why not the lender or the bondholders who are financing the student loan debt in the first place as those who should have skin in the game?
You want me to talk to that? You want to take that up? Go ahead.
Well, I mean, so of the $1.2 trillion in loans that are outstanding, 1.1 trillion of them are all of yours. You do all have skin in the game. These are all federal loans. So we all have skin in the game in that regard. And I think the issue is that some of that needs to be shifted over to the institution that is essentially selling this. I think that, some of these graduate school programs would not look the way that they do if those schools had skin in the game. Although the issue with some of the grad debt is that, the default rates are very low. I mean, for these people, so probably need to think of a different metric for what skin in the game would be for some of them, because the students sort of suck it up and pay it, but they got a degree that they ended up borrowing much more for than is worth.
It's a very good question, and of course you could make a good argument that, for example, home builders are among the biggest free riders on mortgage credit. That's why home builders are constantly down in the Congress arguing for more and bigger government lending programs and mortgages. But another aspect, which in my mind is quite important, is who is the promoter and the deal doer. So in the mortgage business, it's the mortgage lender or the mortgage broker who's promoting the loan and dealing with the customer and getting it put together. And if you then allow that lender who's promoted and made the loan to get completely out of the risk, you get very perverse behavior, as we saw. Well, in student loans, who is the promoter? It's the college. Who is the deal doer with the student? It's the college. So that's why I think we need to have skin in the game at the college level.
Yeah, and
Other comments?
I just wanted to add, I think Jason put it well. I think it's actually more of a rebalancing than more toward the institution bearing some of that risk. So, for instance, the bill that I cited, the Durbin and Reed and Warren proposal, it says, if your default rate's over 15%, you would have to pay back 5% of the outstanding defaulted dollars. Right? Not the whole sum of it, right? And then it'll be a sliding scale. And if you continue to perform poorly or you have a higher default rate, you pay back a bigger portion. So I think the notion is not to put it all on the institutions, because then we have a problem with students bearing no responsibility, right? Potentially for the consequences. But it's a rebalancing. It's a shared responsibility that right now colleges are held harmless, essentially, right? So.
Thank you. Good point. We have time for one more question. I have one in the back here, please. And then, unfortunately, we're going to have to wrap up.
Paul Comby, American Student Assistance. I'm curious if we listen to the dialogue. There's nothing's changed. There's the delinquency problem. There are all these issues. And I guess the fundamental question is, do we really think we have the quality of data that would allow us to actually figure out what the problem is, who's defaulting, who's being delinquent, and how to solve the problem? A good example is skin in the game. If you look at defaults, they are the lower balances because they are at community colleges. So to some degree, we could be punishing those schools that are bringing people in to try. And the counterpoint to the graduate problem, which I agree with Jason, is the risk associated with someone who tries at a community college and fails. And we got to be able to balance those things. And do we really have the data that allows us to make really concrete policy decisions that don't have unintended consequences?
Okay, gentlemen, do we have good enough data to make these decisions? Matt?
No. I mean, the data we have are better than nothing. I think we can learn useful things from the data we do have, but I completely agree we need better information. Right now we have this sort of patchwork of, the New York Fed data are good for this, and the Survey of Consumer Finances are good for that, and NIPSAS are good for that, and the cohort default rates are something else. So I don't think it's possible to have the one perfect data set, but better data is always a good thing, and I think it's particularly a good thing in this case.
Tragic nature of life is, with or without data, we have to act.
Well,
yes, go ahead.
Well, no, and that's sort of my point here, is that what happens a lot in Washington is that the status quo is always held to a very low standard of data needed to justify it, but the proposed change is always held to a sort of gold-plated standard of data that we need, right? So when I was talking about putting a limit on public service loan forgiveness, someone from the financial aid community said, well, shouldn't we examine this and look at some data to figure out what the right limit is? And I was like, well, but no one used any data to justify creating the program in the first place. So the data issue is we do need to move on, but and Matt's paper is great. There's this is using the best data available, and that's what we've got so far.
Yeah, I mean, to do Matt's word, patchwork is perfect, because to do any kind of paper where, even just looking at what do borrowers or plus loans look like, and where do plus loan dollars go to, you have to use 3 or 4 different data sets, because you just don't have comprehensive coverage. Of course, there's a ban on the collection of student unit record data at the federal level that was put in place in 2008 as part of the higher ed reauthorization back then. So. That's a stumbling block to some of this, certainly.
All right, that very interesting set of points has brought us to 2 o'clock. It only remains to thank you all for coming and to thank our panel for a great discussion.